We're going to go through some of the basics of Forex. We're going to look at how trading works, who can trade financial instruments, and how they can be traded. I'm aware that some of you may be already familiar with trading any of the financial instruments, but we are now just going to go briefly through all the basics for those that hear about trading for the first time. So some of the financial instruments that you can trade are stocks, commodities, equities, ETFs or exchange traded funds, Forex, and bonds or government treasuries. Now you may be wondering, why would we want to choose one market over the other? We actually prefer to trade Forex because of various reasons that we are also going to look at a little bit later in this video. So the ideal instrument, as I mentioned, depends on the few factors, but the main factor is the sum of money that you have. So, for example, government bonds, it will be very difficult to trade them if you have only very small amount. Whereas in Forex, you can actually trade with a very small amount. This also makes Forex the most traded instrument among all. Now let's take a look what Forex even is. So the Forex market, or with other words FX or currency market, is a market which allows you to change one currency for another. It's actually that simple. So if you traveled to a country which uses different currency, you had to convert your country's currency into another currency. That means you have been involved in the foreign exchange market. When trading Forex, we never trade one currency, but we actually trade a currency pair. This means that we have a base currency and quote currency. So let's say that we have a chart of Euro USD and we believe that the price is going to increase. So let's say by 0.1%, or it doesn't matter, or 50 pips. That means that we're going to buy Euro USD. That means that we are going to actually buy Euro and sell USD. So this may seem complicated at first, but this can all be done in only one trade. Everything else is done by our broker. So we only, let's say, execute a trade on one currency pair, and that's it. It's actually that simple. Forex is the largest financial market in the world. The main participants in this market are international banks. The part that we traders are part of is only a very small portion. The largest stock market, New York Stock Exchange, has a volume of $22 billion each day. That may sound like a lot of money, right? But if you compare 22 billion each day to Forex, you would be surprised, because Forex market has a daily volume of $5 trillion. Now let's explain why Forex is more popular than other financial instruments. One of the reasons is leverage. So what leverage means is that if you have a very small amount of money, you can actually control a much larger amount with leverage that is provided to you by your broker. That may be 1 to 30 or 1 to 100 or even 1 to 500. Now, there are a few reasons why traders prefer Forex to other instruments. The first one is liquidity. This refers to the ease of buying and selling a financial instrument at any given time. Instruments with high levels of liquidity tend to be easy to trade because you can enter and exit a position with ease. So obviously you would have a problem if you would want to exit the trade because the trade is going against you. You would want to sell your position, but there wouldn't be anyone on the other side to buy it. Or if I give you even a simpler example, if you have, I don't know, 100 apples that you would like to sell to make some money, you need buyers, right? Because you may have the best 100 apples in the world. They may be extremely tasty, but if there isn't anyone on the other side that would like to buy them, you have a very big problem. So the next one is volatility. Volatility refers to the ability of financial security to rise and or fall sharply. This, however, comes with a twist, because the more volatile the instrument, the greater the risk, and of course the greater the reward. Put simply, if let's say a currency pair can move very fast up and down, so rise and fall, we would say that it is very volatile. And if we know what we're doing, this is a very positive thing, because it shortens the period that we are in a trade. And last but not least, transaction costs. It is very cheap to buy and sell currency pairs, which is extremely good, because, for example, some other instruments are much more expensive and you have to pay fees just to buy and then again to sell. That is it for this basic introduction. If you have any questions, leave the message down below and make sure to subscribe, click the bell to be notified when we drop the next video. I hope you found this video helpful, and I wish you a good trading week.